Monetary policy affects the economy and inflation with uncertain lags, and the full effects of our rapid tightening so far are yet to be felt. Thus, it makes sense to moderate the pace of our rate increases as we approach the level of restraint that will be sufficient to bring inflation down. The time for moderating the pace of rate increases may come as soon as the December meeting.
Well, 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 there you have it, folks. The bear market's finished. The bottom's in. Uncle Powell said so. In all honesty though, the bear market's probably not over, but I mean, look at all this price action here. Everything from the Dow Jones to the DAX to currencies to commodities to agriculture to even bonds is going up. I mean, this is some pretty crazy stuff. Two glaring weaknesses today were the VIX basically collapsed, and the US dollar, which didn't go down as much as I thought it would, but that's actually been a bit of a positive for assets like gold. And as you can see, gold and USD look like they're sort of trading inversely of each other. And coming back to the VIX, I mean, everyone thought the last couple of days it started creeping up, and they were like, oh, it's going to go up to 30 and it's going to go up to 40, and then we're going to get a crash and everyone can get back into the markets and get rich. Well, yeah, it just doesn't work like that, I'm afraid. Currently, it looks like the VIX is headed towards the sub 20 level if it keeps going at this rate. And the star of the day was undoubtedly the NASDAQ. The tech stocks, which have been beaten down over the past 12 months, have sort of made a bit of a comeback, but I still think there is more pain ahead for the sector as a whole. I'm more bullish on value sectors like industrials, materials, and energy and financials going forward than say tech, because I think this sort of reversion to value is only just getting started, and I think tech has still got a lot of value to shed in the next few months. So for the rest of the video, I'll be explaining why Jerome Powell started talking about slowing down rate hikes, and I'll talk about the strong sectors, about the weak sectors, and I'll sort of prognosticate how long this rally might go on for, and it might be going on for some time. So the biggest reason why I think Jerome Powell has sort of become dovish all of a sudden is because of this yield curve inversion that's been happening, especially in the 10-year and 3-month bond maturities. As you can see, it's basically plummeted from a +2 to a -0.7%, just in a matter of about 6 months. If you look back in history, there hasn't been a more rapid inversion. This chart goes back all the way to the 80s, and it shows that this inversion has only occurred about a handful of times. And if you look at the slope of the current inversion, it's very steep, and this is one of the key sort of indicators that the Fed looks at when it comes to gauging how fast or slowly it's tightening, right? And basically, when the yield curve inverts, it's telling us that the Federal Reserve is tightening monetary conditions faster than it should be. And why does the Fed care about this yield curve inversion? Because it predicts basically with 100% accuracy the onset of a recession in the near term. There's probably going to be a recession, but hey guys, just because there's going to be a recession, it doesn't mean the stock market is going to crash, okay? So basically, Jerome Powell is a bit wary about continuing this rapid rise in interest rates, rapid hike in interest rates, because of the lag effect. He talked about the lag effect and how the economy sort of lags rate hikes, and no one wants to crash the economy unnecessarily. And I think that's going to provide some bullish tailwinds going into the new year, into the first quarter of next year. So let's look at some sectors. So this is the RSP, which is the S&P 500 equal weight index. It's not the S&P 500. It's looking pretty bullish right now. I mean, it's broken through that upper channel on pretty significant volume, and I mean, this positive volume over the last couple of weeks is undeniable. Last 2 months actually. You can see a pretty positive response here from the buyers. It's sort of formed a bit of a double bottom here, once back in June, and then another in October, and it looks to be bouncing pretty strongly up into the 150s area, and this is pretty bullish. Looks pretty bullish to me going forward. Moving on to Tesla. I mean, the Tesla's been a struggling stock all year. Look, I mean, it's had a bit of a bounce, but I'm still pretty bearish on the stock in general. Still overvalued. I think it's got a lot to catch up. And I think with all this overhead supply, look, everyone who bought in this area is at a loss. Think about that for a moment. We're in the bear market ratio, and regardless of that fact, everyone who bought up here is now in loss. And look, think about what they're going to be doing as soon as it comes up to their break-even point. A lot of these people are going to sell, right? They just want to get the hell out of this market. And that will sort of keep the price suppressed, in my opinion, unless there's some sort of a bullish surprise coming from Tesla corporate, which I sort of doubt, considering the economy is about to head into a slowdown. Yeah, Apple. So, I mean, this is just a juggernaut. It just won't go down. Yesterday, it just reversed. Everyone thought it was going to go down, especially because of the economic slowdown and sort of Foxconn factories getting shut down due to COVID. But hey, people just keep buying the stock. It's it's the world's biggest stock for a reason. Now, speaking of China, look at Alibaba, probably one of the most disappointing Chinese stocks of the decade, and looks set to be bottoming out here. There's a bottom here, but that bottom gets undercut by this low here in late October. But I mean, with the rise in buying recently, this could be a bottom. I'm still sort of pretty bearish on the stock, simply because it's gone down so much in the past, 12 to 18 months. Everyone who's bought up in this area is still sitting at a loss. And, with this, it's the same as the Tesla stock. A lot of these people just want to get the hell out of this stock. And if it gets back to their break-even point, that's fine. And like with Tesla stock, that's going to keep this share price suppressed. I think there's better opportunities elsewhere. Now, Home Depot is a stock that doesn't get talked about very often, but it doesn't take a genius to figure out that this is a sort of an economic bellwether stock. And even with this declining home prices, Home Depot seems pretty solid. I mean, look at that. It looks like it's found some sort of triple bottom here. Bang, once in June, then in September, and a third time in October. And the last couple of weeks, it's been going up on increasing volume. I mean, that's significant buying here, folks. That's significant buying here. Yes, there is some overhead supply, but look how flat this is compared to, say, Tesla or Alibaba. A lot of the sellers have been, churned through in this whole area over the past 6 months, and now the stock looks ready to really retest the upper range of this channel, which is about 410, it looks like. Another economic bellwether stock is Freeport McMoRan, which is one of the world's largest copper producers, copper miners. And of course, copper is such a valuable commodity. It's such an important commodity. It's probably one of the most economically sensitive commodities out there. If copper starts going up, then that means the economy is probably in pretty decent shape. And not only have we seen a rally in copper futures prices, but we're also starting to see copper equities, like copper miners, go up as well. So there's other stocks like Southern Copper Company, Antofagasta, which is a Chilean copper miner. And, all of these copper miners are going up. Freeport is just as an example. And if the price action is anything to go by, I think there's further upside here, especially with the China reopening and the ongoing decarbonisation effort. All of that takes copper, solar panels, electrification, EVs, and all of that. Another interesting commodity to keep an eye on is silver. Now, this is the chart of Hecla Mining, which is a pretty prominent, probably the biggest silver miner in North America, I believe. And as you can see, it's been going up on pretty high volume. It looks very steady. But again, on the commodities front, silver is looking pretty strong at the moment. Silver futures look to be recovering. And again, silver is a bit of a green metal in the sense that it's used in EVs and solar panels. And there's a dark horse in gold. Now this is the chart of Newmont Mining, which is probably one of the world's largest gold miners, and I think the only gold mining stock that is in the S&P 500. Now this sleeping giant looks to be awakening from its slumber, but I'd really want to see at least a couple more weeks of solid price action on the upside before you can say that this downtrend is firmly broken. So let's look at some market internals. This is a chart of the percentage of stocks above their 200-day moving average, and it's been rising sharply ever since the ever since the start of October. This chart basically shows you that the breadth is pretty strong in this current rally. A lot of stocks are participating in this rally, so it's not just a select basket of stocks. It looks like a very broad-based rally, which is really good to see. And that's one of the reasons why I think this rally is sustainable. So I don't really see any reason to fade this rally. I think this rally has some substance behind it for sure. So what are some near-term catalysts besides the FOMC meeting on the mid-December? Today we've got the ISM PMI numbers coming in. So this is the producer manufacturing index, which basically just gauges economic activity, and the higher the number, the better it is, right? So as you can see, this chart shows that the number has been going down. Anything above 50 is an expansion in manufacturing. Anything below 50 is a contraction. So we really want to see a number higher than the last one. So the last number was 50.2, and the consensus for the incoming number, which is November, is 49.8. So we really want to see something higher than 49.8 and sort of reverse this trend. If it does, then we could see a huge rally in commodities, especially commodities like copper and possibly oil, and it's probably going to lift the value sector as well. So look out for that number coming out today. I'm hoping it'll be something like 51. Just a huge surprise would be nice. But even if it does fall, even if it falls below consensus, look, it's not the end of the world, because a lot of it has been priced in, I believe. And looking at the PMI numbers historically, you can see that quite often once the PMI numbers bottom out, it's followed by a subsequent rally in the equities market. So for example, in 2002, the market sort of bottomed out around that time, especially the value sector. I think tech continued to decline until 2003, but the value sector sort of bottomed out and started rallying when the PMI bottomed out. And you might say, well, the PMI numbers need to go to the low 40s before they bottom out, but not necessarily. You can see quite often that the PMI bottoms out at around 50 or just below it, and the market subsequently rallies. So if we get that occurrence this time around, then this could actually be the bottom in this bear market. And one other thing that I noticed from yesterday's price action was that if you look at the share volume, so the share volume of advancing stocks versus the share volume of declining stocks was at about a 9-to-1 ratio, which is incredibly bullish. I mean, the last time I think I saw this, I've been watching this gauge for a few years now, every day for a few years, and the last time I saw the ratio this skewed was, I think, around April 2020, and after that we all know what happened. The bull market of a century happened. So I mean, this can only be construed as bullish, right? So don't ignore these facts, guys. Don't ignore these facts. And finally, we'll just look at how the sectors performed yesterday. I mean, Infotech, they had a pretty big sort of relief rally, maybe short covering rally, dead cat bounce, whatever you want to call it, alongside the communication services, which sort of go hand in hand with Infotech. I'm still bullish on sectors like materials and financials, healthcare and energy and industrials, simply because there's a lot of value there, and you can find growth within these sectors. So anyway, thanks for watching, guys. Please like and subscribe and click that bell notification so that you can see when I upload a new video, so that you get my insights as soon as possible. All right, thanks guys, see you next time.